Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 18 weeks ago here and every opportunity since, I have said, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal," and that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either, end of quote. Now, I know I sound so utterly boring again, but this point is important. And I feel I must keep repeating it such that in all the things that's going on this year and going forward, all things should be seen in the shadow of this pattern. Okay, so since the low in mid-August, we have seen the creation of four patterns. Firstly, the mid-August to mid-October bull channel. Secondly, a late July to late September reverse head and shoulders pattern with a bright red neckline above the market, currently at 1024. I previously set out the topside potentials for this pattern, but though we have seen an attempt to try up towards them, especially late September, the promise these posed has remained unfulfilled, and I have retired both the primary and the secondary targets. The main reason for this failure is the capping and slapping of the market by the overhead mode medium moving average, currently at 1009, and to a certain extent, though less so, by the green short medium moving average, currently 1011. These two moving averages still hang over the market. Third pattern is the early July to early October bearish shift pitchfork, highlighted in dark blue on my daily chart. This pattern is still wonderfully operational, still looks good. The market close now to the overhead upper time, currently at 1016. The final pattern is the small November base head and shoulders pattern with a bright green neckline, currently at 1002. This has not as yet been triggered, with the market hugging close to the bright green neckline ever since the completion of the second small shoulder. It is the smallest of the patterns, and I suggest watching the action next to the bright green neckline closely, as so far the market has seemingly not chosen to jump, being supported by the congestion at 990 and capped by the colourful moving averages. We'll wait and see, but the room for manoeuvre in between is getting very, very, very tight. I would finish with what I said 6 weeks ago, which is, I think, still valid. I quote, "Just watch the dark blue bearish shift pitchfork with the immediate bearish angle of attack with some diminishing potential targets topside, or may turn out to be failed targets for reverse head and shoulders bottom." Chicago soybean meal. The main pattern driver in this market had been, I suppose still is, the dark blue November 23 to early May 2024 bearish shift pitchfork. You can clearly see on my daily chart. The market is currently in between the overhead upper time, currently at 298.30, and the middle time below, currently at 250.70. This pattern had been previously breached and arguably broken, with prices having consecutive closes over the dark blue upper time. However, please note this break higher was not a spontaneous move. No, but rather the result of the construction of bullish incentives, notably the mid-August to early October bull channel that petered out, and we saw a subsequent break lower at the start of October. Now, the cap on the market at that time had been the combination of the upper bull channel line and a declining long moving average, currently at 329.60, that saw just a single close over before swiftly turning lower, all at the start of October. The break below the bull channel saw both the primary and secondary targets below achieved. I raised the following point 9 weeks ago about both the primary and secondary targets, and more as well, that, and I quote, "If this should come about, then it raises the point that the dark blue bearish shift pitchfork could have repaired the break higher." I now only need to remind you once again of my words of 67 weeks ago. So that is now actually 77 weeks ago, nearly a year and a half ago, when I said, and I quote, "And ever since when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since," end of quote. If there is only one thing you take away from my musings, let it have been those words. Now, 6 weeks ago, I highlighted a new pattern, one that's developed since that high seen in early October, and it's the bright red mid-May to early October bearish Andrews pitchfork. The market has been running along the top of the middle time for most of the while, which is currently at 278.30. Recently though, departing slightly upwards to hug the middle of the congestion dating from April to August 2020. It stretches between 282 even to 300 even, specifically at 290.70. I do not think this bright new red pitchfork will yet replace the dark blue pitchfork, but rather I suspect they'll be working together, the bright red one having a slightly more acute bearish angle. Chicago soybean oil. The main recent actions here had been the construction of an early July to late August bear channel, leading into a very late August, early November bull channel, which we saw a break higher from in the first full week of November, followed by an almighty dive lower for most of the rest of the month. The igniter for the move lower was the interesting 38.2% Fibonacci line from March 2020 to April 2022 move at 48.95, which I pointed out 6 weeks ago and which had, and I quote, capped prices in July, the start of April, the end of March, mid-February and throughout January, as well as this past week, end of quote. Now, we did see a small bearish halfway hesitation on the way down between 44.5, where the long moving average had been back then, currently at 44.24, and the 46.5 area, where we saw the highs at the end of October and late July. I suppose you can even call the action over most of November a very narrow head and shoulders top pattern, but that might be pushing the envelope a little bit far. Nevertheless, we saw this bearish halfway hesitation potential reached on the downside. Since reaching there, we have been caught within a previously mentioned congestion zone, but within the specific part of it, in between the supports at 40.53 and 41.15, and the May low at 42.52 and the April 24 low at 42.67, and above all, the declining mauve medium moving average, currently at 42.54. Now, we have seen late last week an attempt higher over the topside resistances, but this was at best half-hearted and at worst indecisive, especially last Monday. I suspect the approach to the next overhead resistance, which is the green short medium moving average, currently at 43.62, withered the support and prices have turned lower as a result, but so far not enough to pierce the dark blue lower time, which is currently at 41.88, of a new prospective dark blue bullish Andrews pitchfork, which I drew 3 weeks ago, with the mid-August to late November move. This lower time had been previously penetrated but not fully breached or anywhere near broken. I should stress that this pitchfork is still a very, very early attempt at trying to decipher the bullish angle of attack of this market, and I am quite prepared to finesse it into a shallower bullish shift pitchfork with the same move, or even retire it completely, as all this activity hereabouts could even now be seen as just another bearish halfway hesitation.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.